Are you working with a financial advisor? Would you like to be and are trying to find a good one? Either way, here are 5 questions that you should ask a financial advisor. Whether it's one you are trying to interview to see if they should be yours, or you already have one. If you've never asked them these questions, now would be a good time to start. We'll give you the 5 questions, then also give you a couple of questions to avoid that I see on a lot of popular questions for advisors blogs. We'll break down each question then and say why it's important and what you should be looking for in an answer. This is going to be a longer episode, but I think it's really important because finding the right advisor, the right financial professional to help you is a critical first step in your long-term success. So if you're not willing to do a little bit of homework and listen to an extensive podcast on finding the right advisor and on the questions you should ask, then how are you going to achieve success? So buckle up. There's going to be some great questions. I'll give you the questions right away, and then we'll go back through and dive into each one. So here are the 5 questions. They are, what are all the ways you get paid? Number 2, what is my all-in cost to work with you? Number 3, what are your insurance or product sales requirements? Number 4, what advanced training, designations, or areas of focus do you have? And number 5, what is your investment philosophy? Now, again, you can download all of these questions. We have a simple PDF that gives you the questions and a space to write the answers that you can download, and you can find that at retirementorship/5. Again, retirementorship/ the digit 5. That'll take you right to the blog for this podcast episode, and you can download it there. So we'll dive in again, and here's a couple of questions that you should avoid asking because you'll see these on some of the other ones. Number 1 is, are you a fiduciary? And number 2, what is your investment track record? So we'll go through the whole thing, study all those, give you the reasons for the questions, their importance, and some things you should look for. And then at the end, I'm also going to answer those 5 questions for myself in my financial planning practice. So you can kind of get a feel for what answers might sound like. And then if you're interviewing multiple advisors, well, you've already interviewed one and you've gotten the answers to those questions, and it'll help you to compare to either your current advisor if you already have one, or other advisors if you are interviewing them. But before we get started, first we should ask, what is a financial advisor? And I've got to just clarify what I'm talking about, right? I'm going to use the term financial advisor in this episode as a catch-all for all financial professionals. I think we should actually distinguish them in real life, but most people just call everybody a financial professional. So here's a few distinctions that are in the real world, but then I'm just going to call them all financial advisors just for this episode, right? So there's 3 different types. There's financial service representative, financial advisor, and financial planner. Right, and so in the blog, again, retirementorship.com/5, to shoot a quick Venn diagram, or if you're watching this on YouTube, then we'll put this up on the screen, of the different things that financial services representatives, which we'll call reps, financial advisors, which we'll call advisors, and planners can do. And they're kind of just, right, there's a Venn diagram. So a financial service representative is typically an employee of a financial company, and they're licensed to sell you the financial products of the company they work for, right? They're a financial services representative. They represent the company and sell products to you. A financial advisor can usually do a little bit more than a financial services representative. They often will offer advice, right, on insurance or on investments, and they can get paid for that advice. A financial planner then will do one more step, even more, where they will then typically give you planning and financial guidance on other aspects beyond investments and insurance, which are the typical ways that financial advisors get paid. So they might look at estate planning or tax planning or more cash flow and asset management type stuff. And so they're going to have the broadest spectrum of what they're able to do, right? And a financial planner can often do everything that a financial service a representative can do and an advisor can do. Then you also have fee-only financial planners, which won't sell any of the products that a representative will, but they can give you, again, the advice and planning and everything else. So that hopefully that Venn diagram makes a little bit of sense on the overlap between those. But regardless of who you're working with, right, there are some questions that you should be asking them. And so let's dive into all those questions, right? The first one are, what are all the ways you get paid? And now note the way that this is phrased, right? It doesn't say, how do you get paid? which I think is a way a lot of people might ask it. It asks, what are all the ways you get paid? And the reason we don't just ask how, it's kind of like you've probably been told to not ask yes or no questions, like do you get, do this or do that, where they can just say yes or no. You want them to give you an answer that is drawn out. But if you say, how are you get paid, or how are you paid, they can just answer with one way that they get paid. When you ask what are all the ways that they get paid, they kind of have to, right? If they're being honest in their answer, give you all those ways. And so again, there are 4 primary ways that a financial professional, a financial advisor can get paid. They are commissions, they are investment advisory fees, financial planning fees, and benefits and incentives, right? So for commissions, even that, there are several different ways that people can get paid commissions. There's hidden commissions and visible commissions. So a hidden commission is a commission that the financial professional gets from selling you some product. And the client doesn't usually see that fee. So you won't necessarily know that the rep is getting paid this, that the advisor is getting paid this, because it's buried inside of the product, right? So for instance, when a rep sells you a life insurance policy, you don't see, there's no line item in there for the commission that the rep is getting. Instead, they're just typically paid by the company 50 to 100% of whatever that first year premium was. And again, you won't see that, but the cost, you still pay it, right? The company isn't just paying it themselves, they're paying it out of what you're paying them. The company's in there to make money, the rep is in there to make money, and all that money is coming from you as the client. And so you are still paying this commission, you just don't see it. And, again, commissions aren't necessarily bad. There's a lot of industries too that are all on commission, and I don't have any problem with commissions in general. It just, in finances in particular, right? If you are paying someone, or you think you're paying someone to give you good financial advice, if they get paid by commissions, that's going to incentivize some products, some strategies more than others. And that's something that you at least need to be aware of, if not avoid entirely. And so you want to know, what are all the ways they get paid? What are the hidden commissions that they're earning for the products that they're selling you, right? Annuities have hidden commissions. And again, that's typically a percentage of whatever you put into annuity. So if you put $100,000 in and they're paid a 7% commission, then they get $7,000. And so again, you're not going to see that anywhere, but that is a commission that they're being paid, and they can typically be quite large and quite incentivizing for the rep, for the financial advisor, to recommend these certain products or services. The second kind, you should have hidden commissions, and you also have visible commissions. And the best example of this is on what's called an A-share mutual fund. It's called a sales charge sometimes as well. And that's where if you invest, say, $100 and there's a 5% sales charge, then you will see that sales charge come out, and you'll see $95 hit the balance of your fund. So every time you throw $100 into your Roth IRA with an A-share mutual fund, only $95 will actually hit the mutual fund, and the other 5% goes to the representative who is selling you. Again, not necessarily bad, but there is a clear conflict of interest, right? Where they're incentivized to recommend maybe higher percentage products, or products with a higher percentage of pay than other products, which may be better for you. And if a financial, the other thing you can do is, if they say, I make commission and stuff, is they'll usually get right past that and move on to other things. And so you can pause that and probe into that answer. All right. And by asking, what are the commissions? What exactly do you get paid? Don't let them off the hook. And so you can say, what are all the products that they get paid a commission on? Have them list them all out. Which products do you get paid a commission on? That way, if they ever recommend any of those products, you just know that they are getting paid a commission to recommend those, and you should at least be aware of that, right? What are the exact products, or the exact percentages that they're paid out, right? So what are the products, or what are all the products they get a commission on, and what is the exact percentage that they're paid on each product type, and an example of the dollar amount they would be paid on a typical recommendation, right? Because you have to know that if they're being incentivized to sell these, you will want to know how they calculate that and how much you're ultimately paying them to give you this advice. Right, so we'll throw a table up here on the screen for YouTube. You can see this if you go to retirementmentorship.com/5. I do have a list in here of typical financial products, the commission, the typical percentages in there, an example of what you might put in there, and an example of the commission amount. And it ranges anywhere from $600 a year all the way up to $21,000 in 1 year, and just in these recommendations, or in these examples alone. Right? And so when a financial advisor works for free, quote unquote, but is paid on commission, you really get to start to see how much you're actually paying that advisor when you know all of these types of commissions and all these types of products. So commissions are a big one. It's a big way that a lot of financial professionals get paid. The second way is on investment advisory fees, right? These are either a percentage fee or a flat fee for assets under management. And one of the benefits of advisory fees over commissions is that they're paid to manage your investments well. They're not paid any more or less when you put money in or out. They don't get paid like a commission every time you put money in. And so they want to make sure that your money grows, that it does what it's supposed to do. If when you make more money, they make more money, that whole thing. And whereas with commissions, they're paid to sell it to you, and then it doesn't matter what you do after that. They already got paid on the front end. Where advisory fees, you more have to earn that over time. A third way is financial planning fees, right? A lot of financial planners will then charge a direct financial planning fee, maybe monthly, maybe annually, maybe one time. And that is to pay them for all their expertise on all the other parts of your financial life, right? You don't get paid directly. There's no way to sell a commissionable product on an estate plan or on cash flow or some of these other things. And so you want to pay a financial planner just to give you good advice on those things. And then they don't have to try to recommend a product to get paid on those areas. And the last way are benefits and incentive rewards. Most firms will have certain thresholds, certain quotas that reps need to make in order to attain certain benefits or certain rewards, certain trips and those kind of things. If they sell enough insurance products, then they get to go to Hawaii or to the Bahamas or wherever else. And you can probably tell just based on where I'm going with this, right, that I'm pretty biased towards fees over commissions. I think that when people know precisely what they're paying and what they're paying for, everyone sort of goes that way, right? And it's kind of a duh issue at least, right? That you should at least know what your advisor is getting paid and how much you are paying them for the advice that you're getting. And so then you can tell, am I getting this advice because it's actually good for me or because it lines their pockets with commissions? And again, a lot of people think that they're working with a free advisor, that someone that doesn't charge them, or they're actually free online. And again, we did a whole topic on that called the true cost of free advice, because it's not free, right? Nothing is ever free. So you can check that out. So again, professionals can be paid through commissions, advisory fees, planning fees, and benefits. So make sure you discover all the ways that your advisor is getting paid. Question number 2, what is my all-in costs for working with you? And this question is closely tied to the first one, but comes at it from the other side, right? The first one deals with how much money is flowing into the advisor's pocket, and the second one deals with how much money is flowing out of your pocket, right? Which are not always the same thing, because there's sometimes can be extra layers inside of there. So maybe you determine that what they're getting paid seems reasonable, but there's a lot of extra layers, a lot of other people with their hands in the pockets that you may not know of if you don't ask this question. So again, there are direct costs and indirect costs that you may be influencing. That determines your all-in cost for working with someone. So direct costs are easy, right? These are, and they're easy to find once you start peeling back the onion of what you may be paying, right? So let's say you ask the first question to an advisor, what are all the ways you get paid? And they say, well, I get paid 1% of assets under management. And so you like the idea of the advisory fee versus commission-based investment management. And so far so good. And then you ask the second question, so what is my all-in cost for working with you? And that's where you start finding some of these hidden fees that are still a direct cost to you, right? And so you have some hidden fees, you dig in and you find out that they have a custodial fee, which is a fee that the custodian charges to hold your money there, right? There's a strategist fee that they pay the broker-dealer for creating the portfolio funds inside of those accounts. And of course, the expense ratio, which is the fee paid to the managers inside the funds themselves for managing that fund. And maybe all these things add up, and so all those get stacked on top of an advisor's fee, and perhaps it all adds up to 1.75%. And so, yes, again, that first question said, yes, I get paid 1% of your assets. But when you ask the second question, you realize that your all-in fee is 1.75%, which is almost double. Right? And so you want to ask them both. Questions 1 and 2 are not interchangeable. It's not like pick and choose one. Ask them both to really get the heart of what are they earning and what are you paying. Right? And again, you are probably better off being heavier on the advisor side and lower on the other expense side. If you're going to be paying 1.5 all in either way, you're probably better off paying most of that to the advisor who's giving you the hands-on direct advice and planning and guidance versus pushing all that into additional platform fees, custodian fees, and some of those other hidden fees that can be in there. So there are a lot of direct costs that can add up that affect your all-in cost. Then there's some indirect costs, right? There are opportunity costs and there are potential costs, right? So give you examples, right? Opportunity costs are, I think a lot of people run into this when they're very fee conscious and they're always looking for no cost products, or they don't want to pay an advisor. And so they're always looking for the free options or the no or low cost options, right? And so they hear of like an indexed annuity, right? It's a great example of something that's a no cost product. And so they say, hey, there's this product, it's an index annuity. It follows the index, it follows the S&P 500, but you can never lose money, right? It'll cap you at 0 on the way down. And so if the S&P 500 is less than 0, if it's negative that year, you'll just get 0. And if it's positive, like you get to get some of that income too, and it'll cap you on the top end, but it'll, so you'll make money when the market's doing well, and you'll never lose any money even when it's doing badly. And there's best yet, there's no fee. There's 0 expenses to investing in this product. You're like, oh, that sounds great, right? So what's the catch? Because there's always a catch. If something feels too good to be true, it is too good to be true. And so just one example with this, right? And we'll do a separate episode on index annuities because I've been getting a lot of questions about those. But index annuities have opportunity costs in that they don't receive dividends, right? You aren't investing in an index. You are not investing in the S&P 500 companies that make up the S&P 500. You are tracking the index itself. So when you're actually investing in the companies, when you're a co-owner of these 500 businesses, when those businesses make money, they pay you dividends as the owner. They pay you the profits. But when you are just tracking the index, you are not a true owner, and so you don't make any dividends. You don't make those profits. And just to give you an example of what the impact of this is, over the 20 years ending 2020, I'll just pick that year because it's a nice round year, right? The price return of the S&P 500, right? What the price did over that time, on the average price return was 8.5%. So on average, over that 30 years, it was 8.5% per year. The total return, which means that the price return plus if you had reinvested the dividends, the profits that you'd been paid over those 30 years, average was 10.7%. 8.5 versus 10.7. Right? Which means that if you had invested $100,000 30 years ago, in an annuity tracking the price of the S&P 500 versus an actual index fund as the owner of those companies, your index from that $100,000 over 30 years would be worth $1.2 million, but the actual index itself would be worth $2.4 million. Literally double the return, right? And so this thing that was a free product, it didn't cost you anything, right? You didn't have to pay any money to be in this product. It sounded amazing, and you don't want to pay any fees. You don't like all these things, so it sounded great. Ended up costing you $1.2 million in this scenario. And so there's some opportunity cost there by always looking for the free things or the cheap things. There's also potential costs. Right, and that's something is again same thing. Just to take that example, the product does not have any upfront costs. You don't pay any fees. There are no fees on it. There's opportunity costs, but there's also a potential cost in that if you try to take the money back out in the first 7 years, there's a surrender charge on it. Now, again, you don't have to necessarily pay that fee if you just leave the money in there. You won't pay the cost, and so it's not a direct cost. But it is a potential cost, and that if you want to, they will charge you, 7, 8, 10, 6% of your money just to get your money back out of the product. And sometimes they have caps on the upside, and they have participation rates, and so there's all these other ways too where they can insert potential costs into a product. So even though they can say free or no costs on the banner, there's always going to be opportunity costs, always going to be potential costs buried down below. Which is why, again, it's important to ask, what are my all-in costs to working with you? There's always a cost. Find out what it is, the all-in costs. So again, what are all the ways that you get paid? Number 2, what is my all-in cost to working with you? Number 3, what are your insurance or product sales requirements? You may be spotting a common theme here, right? But these questions are designed to root out conflicts of interest so that you can make the best choice, right? We want to make sure that you are getting good advice. And if they're just selling things to you to make money, that's not going to be good advice. And so managing conflicts of interest when you have a sales quota, when they're required to sell a certain amount of product to you, that's really, really hard. right? And you can have, again, great people who want to do great things, but there are often internal sales cultures that promote and celebrate huge insurance sales. There's lavish vacations that are given out to those who sell the most products. And the focus is always on selling insurance, not planning, investing, or helping clients. Right? And this culture is not always present, but it's certainly present in a lot of insurance companies. And these insurance companies are highly profitable. Their products are highly profitable, and they're able to really push and encourage their reps and their advisors to sell these products. And so you want to know, right? Are they recommending this product because it's actually good for me and it's actually best for me, or because they have a product quota that they need to hit? Because those are two totally different things. Right? And so if you don't want sales quotas, right? Some people may think it's fine. They're like, oh yeah, I don't care if they just have to sell me this product so that they can go on vacation. Like, it sounds like a great product. I want to buy it. But you may decide, I don't want to work with anyone who has a sales quota. I don't want to constantly deal with the conflicts of interest or to feel like I'm being sold a product. And so how much right? How would you know if you're going to be sold or not? Well, here's a key insight, right? If the advisor works for an insurance company, then they have a sales quota. If they work for an insurance company, they have a sales quota. It doesn't matter if the company also does investments, financial planning, estate planning, everything else. If it's an insurance company, they do have a quota, right? So and if you don't know what those are, right, here's some insurance-based companies that have sales quotas. Here's some examples, right? Northwestern Mutual, Mass Mutual, Mutual of Omaha, Thrivent, Prudential, Guardian, New York Life, AXA or Equitable, Securian, right? There's a whole bunch. And all of these companies, they produce insurance products, and then they also have an investment and financial planning wing that does all the other things. But their main job is producing and selling insurance products. And you also want to be aware of masquerades, right? That you will look out for firms that are doing business as another firm, but they're really just an insurance firm masquerading as an independent financial planner, right? So perhaps you're evaluating advisors, right? And this advisor works for Clarity Financial. And that sounds promising until you check their website, right? In the bottom of every website, you'll see who the actual company that they work through is. Right? So in the disclosures, you find the phrase, insurance, investment, and advisory services offered through Southeastern Mutual Life Insurance Company. Right? So the real company you're working with is Southeastern Mutual Life Insurance Company. And Clarity Financial is the doing business as name that they have put on the local firm. All right, so you can do your own questions. You can do your own research. You can look up companies ahead of time. You can simply ask them the question like, hey, do you ultimately work for an insurance company? Do you have sales quotas? What are they? On which products, etc.? And if you just want to eliminate all of that, and you're like, no, that sounds like a ton of work. I don't want to be looking up client websites and digging through fine print and all these things just to find these things. And I don't want to have awkward conversations where I have to ask them. Well, then what you really want is a fee-only fiduciary financial planner. Right? And these professionals never earn quotas, or they never earn commissions. They never earn any kickbacks. They have no sales quotas of any kind. And you can find one at feeonlynetwork.com. That's feeonlynetwork.com. And everyone on that site will be able to answer none to the question, right? What are your insurance or product sales requirements? Question 3, right? They'll be able to say none. I don't have any. I don't sell any products. And so I don't have any quotas or requirements. So if all that sounds like too much work, just find a fee-only fiduciary financial planner. You're good to go. Question number 4, what advanced training, designations, or areas of focus do you have? And this question becomes more and more important the more complex your situation is or the closer you get to retirement, right? Someone who's just starting out in their career has $1,000 saved and it just wants to get going in the right direction. It's not as critical as someone who's got $1 million+ and they're 2 years away from retirement and they're really trying to figure all this out, right? And so there's a few different things that you can look at, right? One is just the different licensing and training, sales training that they might have. So a lot of times you think like, oh, they're a professional, they're licensed, they know what they're doing. But for a lot of people, first of all, the licensing process doesn't really teach you how to be a good advisor. It's all about the laws and the regulations and those kind of things. And you can pass all the exams that you need and get all the licenses to be a paid financial advisor and still know nothing about actually helping people. And so the license, it's just like, have you ever done that in the real world, right? Where you took an exam, like in a class, and you passed this class and you got an A in the class, but you still have no idea what you're doing in the real world. It's the same thing. And so most professionals, they do that, and then they get most of their additional training as sales training. from the wholesalers and from the sales managers that they work with. And a lot of their training involves how to sell those products and how to overcome objections and how to convince people who don't want to buy anyway. And do you want a financial advisor whose only training is in sales? I don't think so, right? And thankfully, there's a lot of great institutions out there that produce designations, that produce real advanced training that help people gain extra knowledge and expertise and can be better. And so you want to look for advanced designations, right? And there are designations that are very popular, but some of them are really bad, right? And it sounds good because they have the designation, but they're frankly terrible designations, right? So do some research on those. Don't just look for letters. Know what the letters mean and why they're important, right? So for example, CLU is a very popular designation, and it stands for Chartered Life Underwriter. And it signifies that this professional has extensive knowledge in life insurance, in particular life insurance, and how to sell it and how to fit it into any and every situation. And so for those who want basic term life and invest a difference, then it doesn't really matter. You don't need permanent life insurance in your portfolio. And so someone who's got advanced training on how to sell you permanent life insurance is not going to be a helpful designation. In fact, if they have the CLU designation, they probably will recommend you life insurance. And so if you are trying to avoid that, you would just, in fact, avoid anyone with the CLU designation. Or what about CLF, right? That sounds great. Jack Johnson, CLF. And it sounds important. It sounds like they know what they're doing. But it stands for Chartered Leadership Fellow. And it's for financial services managers to train them how to recruit and train financial services representatives to go out and sell financial products. So again, it doesn't actually help you in your situation. And so you will want to find, know a few that are good. The gold standard designation is Certified Financial Planner, the CFP. And it's widely recognized as kind of the main designation for holistic financial planning advice. And it's expensive to get the training. It's very time consuming. It finishes with a grueling 6-hour exam. And it makes those 45-minute final exams we had in college look like a pop quiz in comparison. And it requires 3 years of experience and rigorous continuing education to make sure that they get that level of education, then keep it, right? And it's administered by the CFP board, which makes people stick to these codes of ethics and guidelines and all these things. So it's the whole package is the Certified Financial Planner package, right? A close second might be the Chartered Financial Consultant, or CHFC, which is pretty close, but they don't have the CFP board equivalent, and it's not quite as in-depth as the CFP. And so, again, working with a CFP may be more expensive, quote unquote, than working with someone else who's less experienced or less knowledgeable. But again, if you pay a CFP 100,000 times more over your lifetime than a simple advisor, but you end up with $500,000 more due to better tax and risk and investment planning, then was it really more expensive? No. Again, that's where we fall into this trap of thinking that free advice or cheap advice is better. So again, just figure out, especially for what you need, are there advanced designations or areas of focus that these people have that might go with you? So again, some focus on dealing with real estate investors, and you're not a real estate investor. Well, that would be helpful for you. So what advanced designations or areas of focus do you have? And then finally, question 5, what is your investment philosophy? And the purpose of this question is to help you distinguish between different advisors and hopefully identify a philosophy that resonates with you and that you could see yourself believing and following, right? And you'll get a wide variety of answers to this question. Some of them may sound the same, and I can't tell you what to look for, right? Because it's your situation, and I don't know you personally, and I don't know what might appeal to you. But let me give you a couple of thoughts of things to consider as you listen to the various answers. The first is to beware of the risk tolerance questionnaire. Right? Beware of a risk tolerance questionnaire. There's this common practice these days to invest clients' money based on their risk tolerance. And the premise behind this is somewhat sound, right? It's the idea that if a client's portfolio is riskier than they can handle, they might panic out at the worst possible moment and lose tons of money, right? They might turn a temporary decline into a permanent loss by getting out of the market when it's down and not being in it when it comes back up. And so this sounds reasonable, but it does not work in practice, right? And you often won't be invested in your risk tolerance so much as based on a risk tolerance questionnaire. And that's a big difference, right? So a new client will answer a 10 multiple choice questions on a form that may take them 5 minutes. The professional will then take those answers to those 10 questions and it'll generate a score. And based on that score, they'll select a model portfolio from a series of them and invest your money accordingly. And so again, in case you missed that, you will spend 5 minutes on a questionnaire that will determine the rest of your investment life. 5 minutes for the rest of your life. Right? And that's just stupid. Right? So suppose you went to a doctor and they said, hey, here's the 10 multiple choice questions that we give everyone. Fill it out. It'll tell me exactly what you have, and then I'll prescribe a medicine. No tests, no conversations, no education. You diagnose yourself, and then we will give you a drug. That's ridiculous. And something as important as health, right? You wouldn't let a 5-minute multiple choice questionnaire determine the treatment. And so why do we let our entire investing life be determined by a 5-minute questionnaire? Why are we as investors content with this? This is ridiculous. And so if the answer to their investment philosophy question is, well, we determine your goals and then invest you based on your risk tolerance, then you may want to keep looking, right? And we did a whole episode on this, episode 21. You can go to retirementmentorship.com/21. The whole thing called risk tolerance is stupid. It's honestly one of the dumbest ways to invest people. And so if your advisor has invested you that way, or you're looking for advisors and that's the way they say they're going to invest you, keep looking, please. At least listen to that episode, and if you're not convinced by that, then go for it. But I think you will be. The other thing to be on the lookout for is beware of grand promises, right? It will also be a red flag if their answer sounded anything like this, right? You ask them, what's your investment philosophy? And they say, well, we use a strategic method to get you in and out of the market, so get you in the market when it's doing well, and then get you out before a big crash. No one can do that, right? Or maybe they say, through our rigorous process, we've identified the best funds that will outperform the market in the coming years. Again, that's not possible. Or we provide above average returns while minimizing your risk. Ditto, you can't do that. We have strategies and products that can help your wealth, protect your wealth, and guarantee an income for you so that you don't need to risk it all in the market. Go back and listen to episode 2 of this podcast and then decide if that philosophy sounds acceptable to you. So again, this question might generate some interesting answers. They're probably going to be all across the board, and some may entice you and some may repel you. But if you were entrusting the growth of your lifetime savings to someone, you should probably at least know their philosophy. So again, just to recap, we're 30 minutes into this thing, but I think it's an important topic. So the 5 questions are: what are all the ways you get paid? What is my all-in cost to work with you? What are your insurance or product sales requirements? What advanced training, designations, or areas of focus do you have? And what is your investment philosophy? Again, you can download all these questions in a simple PDF that gives you places to write down your answers. You can take it with you as you interview your current advisor, or if you're interviewing different advisors, you can bring that with you as well, and you can write them all out in there. You don't have to give us your email or give us anything for this. Just go to retirementmentorship.com/5. Just click the download button and it just downloads the PDF and it's there ready for you to use it. Okay, a couple of dumb questions to avoid. Right? If you Google lists of questions to ask a financial advisor, I see these on a lot of them and they're dumb questions. The first question is, are you a fiduciary? Right? And many blogs recommend that you ask this question, but it's a dumb question. And don't misunderstand, right? I definitely want you to work with a fiduciary, and I definitely want you to know if this person is a fiduciary. But asking someone if they're fiduciary is like asking them if they're honest. What are they going to say? No, I'm not honest. No, they're always going to say yes if you ask them this question point blank. We addressed this extensively in episode 88, What is a Fiduciary? If you haven't listened to that, I would highly recommend that you find that episode, retirementmentorship.com/88, or just scroll back through your podcast player until you find that one. And click on that link or in the blog here, read, listen, watch, whatever you want. Make sure that you've ingested that episode. But here's the short version of that, right? First of all, if you don't know what fiduciary is, it means that they must have a certain level of professionalism and a certain level of care when dealing with clients' money, right? So there's 2 different standards. There's the suitability standard, which means that a professional can make a recommendation as long as it's suitable for you. As long as it somewhat improves your situation, they can recommend it. Right? It doesn't have to be best. It just has to be good. And this is a pretty low standard, right? Because there are no financial products out there that are outright harmful, at least none in like the mainstream that you might get recommended, right? And they're almost all good for clients if they're appropriately used. But the suitability standard is always blatant conflicts of interest, right? If option A and option B, you have two options here, right? A is definitely better for you, the client, but B pays way more to the advisor. As long as B is good for you, they can recommend B and just completely ignore. Don't even bring up option A, which is dumb because option A is clearly better. And so the suitability standard is like no one should ever take any advice under the suitability standard. The fiduciary standard means that they must recommend what's in the client's best interest. So again, you have option A and B. Option A is clearly better for you. Option B pays the advisor way more and still good for you. They have to recommend A. They cannot recommend B. They could tell you about it and they say, well, but based on these, like this is way better. So we recommend option A because in your best interest, right? And obviously you would want to work with someone who has that level of that requirement to act in your best interest, right? But here's the problem with asking if they are, right? If a professional uses any kind of fee for service model, then everything they recommend under that is supposed to be in your best interest. Right, which means that if they manage your investments under a fee-based advisory model, then they must manage those in your best interest. The selling of commission products falls under the suitability standard, right? So again, you definitely want one, but here's why it's a dumb question. Because of how it's asked. Are you a fiduciary? Right, and so if an advisor does manage your money under a fee-for-service model, right, they charge a assets under management fee, then they can say yes to that answer. Yes, I'm a fiduciary because they are fiduciary on those assets, right? If they invest in you, if you pay them a percentage of your assets, they are a fiduciary for those assets, but only for those assets. So they are a fiduciary for that, but they can also sell you financial products in the rest of your strategy that are merely suitable. But because they said, yes, I'm a fiduciary, because they are a fiduciary just on this part, you now believe that all their recommendations are fiduciary when they're not, or when they may not be. And so you can't discover if they're a fiduciary just by asking them. Again, go read or listen to What is a Fiduciary, episode 88, and you can find out more about how to actually determine who's a fiduciary and who's not. And if you want a shortcut to a true fiduciary, then go to feeonlynetwork.com. Everyone there is a fee-only fiduciary certified financial planner. They only get paid by fees by you, the client, and thus everything else they do is under the fiduciary standard. No commissions, no suitability standards, no perverse incentives. Okay, that's the shortcut. That's the easiest way to do this. So don't ask, are you a fiduciary? Just find out if they are separately without asking. The other dumb question to ask is, what is your investment performance track record, right? This is frequently recommended, and here's why it's a dumb question, right? There is no evidence for the persistence of performance. There is no evidence for the persistence of performance. Find me an advisor, right, who's bragging about their track record, and I'll find 10,000 portfolios that outperformed them over the same time, and 1,000 examples of money managers who were outperforming and then proceeded to underperform in the years coming. Right? Invest on principles, on proven principles, not past performance. There's a good reason why the disclaimer, past performance is no guarantee of future results, is required on any statements about performance. So just keep that question out of your list. It's not relevant. Just because they have had a great track performance in the past doesn't mean they can continue that. There's no evidence to suggest that it will continue. And so it's just a dumb question because there's no way, there's no facts about the future. There's no way for them to know. And all you care about is their performance in the future. And that is unknowable. Right? So you want to find someone who's investing based on great principles, not on past performance. Finally, to wrap up all these things, right? Let me give you some examples about how this might look like. We're going to go through each of the questions, and I'm going to answer them from my financial planning practice, which is Lacrosse Financial Planning, right? So these are the real answers for my practice as it stands today. And we're re-recording this in January of 2023 and recording back over when this was originally published in 2021. So question number 1, what are all the ways that you get paid? All right, so my team and I at Lacrosse Financial Planning are fee only. We only get paid by you, the client. We receive no other commissions or kickbacks of any kind. We are not incentivized to recommend one strategy or investment over another. We charge either a flat monthly fee or a percentage of assets billed to your account, depending on your situation. All of our services are offered for that one fee, and it's the only way we get paid. It's enforced by NATFA, which is the largest fee-only organization, and you must adhere to all their strict definitions of fee-only in order to qualify. So that is the only way we get paid is a fee by you, the client. Question number 2, what is my all-in cost to work with you? You pay us one fee for all of our services. Financial planning, retirement planning, investment management, tax planning and prep, estate planning and execution, and insurance advice. We use low-cost index funds, which have very low expense ratios, and so that you only pay our fee and those low investment expense ratios. Right? There's no other cost. There's no custodian fees. There's no strategic fees. There's no commissions, no kickbacks, no anything. We value transparency, and we put our money where our mouth is. You can actually see our fee at laxfp.com/pricing. laxfp.com/pricing. We are one of the only people I've ever heard of who actually publishes their fee because we put our money where our mouth is. We say we value transparency, and we are actually transparent. Shocker. Number 3, do you have any insurance or product sales requirements? None. Right? We don't have any. As an independent fee-only firm, we are not owned by a bank or an insurance company or broker-dealer, and we have no quotas of any kind. We do not sell any products. We provide insurance advice, but we don't do insurance products because those always pay a commission, and so no insurance products. So no products, no sales requirements, no anything. Anyone who works for us, they get paid based on how much they're helping other people, but there's no quotas. There's no requirements for them to do anything. Number 4, do you have any advanced training designations or areas of focus? So I have the Certified Financial Planner designation, which again is the gold standard in comprehensive financial planning. Everyone on our team either has the designation or has already passed the exam and is waiting on other requirements to be able to use it. I also have the enrolled agent license to represent taxpayers before the IRS, to give tax advice, and to prepare tax returns. You will never hear from us, right? Oh, I can't answer that. Go ask your tax advisor, because we are your tax advisor. I focus on working with folks over 50 to help them retire successfully and stay successfully retired through comprehensive financial planning and behavioral investing. Michael Schwartz, he's also a CFP. You've heard him on the podcast a few times. He works with medical professionals specifically, and Ben Gibson, MBA, CRPC, works with millennial and Gen X clients. You can find links out to their specific focuses in the blog for this podcast if either of those apply to you. And finally, question number 5, what is your investment philosophy? So again, we invest based on principles, not predictions. Right? And our philosophy cannot be explained in this small space that I'm trying to do inside this podcast, but we do explain it more face-to-face before we ask you to work with us. Right? Our second free meeting, right? We do 2 free meetings to start people off with a new client, is our strategy session. And that's where we usually demonstrate our investment strategy. You can also learn more about it in my book, 3D Retirement Income, Creating a Retirement that Outpaces Inflation, Outlives You, and Outperforms Others. You can get it in paperback, hardcover, or ebook for free at retirementorship.com. So again, I'm not hiding my investment philosophy. It's all out there in my book. You can read it for free. I just can't answer that whole thing now, because obviously if you would want someone with a philosophy that's a little bit more involved than 20 seconds. So in conclusion, there you go. Right? You just asked 5 questions to a financial planner. It's 1 down. If you already have an existing advisor, you could go ask them the same questions, and now you have 2 data points with which to compare. If you're looking for other advisors, you could ask it to 2, 3, 4 of them. But then you really know the market, you'd see what's out there, and you can find the best advisor for you, whether it's the one you have now or whether it means switching to someone else to get better planning and better advice. You can find the whole list for this whole thing, the whole blog, all that at retirementorship.com/5 for the 5 questions, right? That's easy. Then find one more professional, preferably an advisor planner, and ask them these questions. You'll have, again, lots of stuff to compare to, and you can make the best decision for yourself. Again, easy download, no email, nothing required. Just go to retirementorship.com/5, download the questions, ask away, make the right choice. If you have questions about this or any other topic, you can email us at questions@retirementorship.com or call us 1-855-6-MENTOR and leave us a voicemail. We'll respond to you directly, and if we get the same questions repeatedly, we'll turn that into an episode. Hopefully this has been helpful to you. Thanks. Have a great day. Cheers. If you enjoyed that, you would love being part of our free membership community. It's called Retire Membership, and it has a host of benefits all for free. For example, you can always buy my book, 3D Retirement Income, on Amazon. But if you join us at Retire Membership, we will send you either a hard copy or paperback for free, provide the ebook and the audiobook so that you can listen to it if you don't have time to read it. In addition to that, we'll also provide you with a bunch of content that you can't get anywhere else. For example, we have our quarterly Retire Mentorship magazine, which comes out quarterly and has no ads whatsoever. It's just timely content to help you stay the course. We also have workbooks for our free online workshop to help you get the most out of those, flowcharts to help you make better decisions, and a weekly email to provide timely content that you can unsubscribe from at any time. We never ask for any payment information, and we never share your information with anyone else. We just want to provide timely content and help you stay the course to retire successfully and stay successfully retired. There's no reason to wait, so join us now at retiremembership.com, where you can click in the link in the description and it'll go right there. We can't wait to see you in the community. Cheers. This podcast is educational only and is not investment, tax, or legal advice.